Welcome to This Explainer. Today, our goal is to take a seemingly dry, complex topic and break it down into really clear, memorable takeaways. We are demystifying joint venture bookkeeping. Specifically, we're going to look at how to handle the accounting when you and your partners decide not to maintain a completely separate set of books for your new endeavor. Okay, let's dive into this, because it's a fundamental question that honestly trips up a ton of entrepreneurs. How do you track profits if you don't keep separate books? Think about it for a second. You want to partner up on an exciting project, but let's be real, you really want to avoid the administrative friction, the software costs, and just the sheer hassle of creating a brand new set of accounting books from scratch. But how do you actually track the profits and losses accurately without that dedicated ledger? It sounds like a recipe for absolute chaos, right? Well, as we'll see, it doesn't have to be. Here is our roadmap for today. 1. No separate books, no problem. 2. Method 1, single co-venturer. 3. Method 2, all co-venturers. 4. Method 3, the memorandum account. And 5, the final profit share. All right, section 1, no separate books, no problem. The golden rule here is this. When you bypass creating a separate set of books for your joint venture, that financial data still has to live somewhere, right? And that somewhere is directly in the existing books of the co-venturers themselves. You're basically piggybacking on the accounting systems that you and your partners already have in place for your regular, everyday business activities. It's a highly efficient, elegant solution that saves time and resources. But to prevent a massive accounting headache down the line, it requires a very specific set of rules to keep that joint venture data organized and completely distinct from your daily operations. Moving along to section 2, method 1. Single co-venturer. Under this first method, things are pretty straightforward. You designate a single person to do the heavy administrative lifting. That specific co-venture just opens a joint venture account right in their own personal ledger. Its one and only purpose is to capture all the revenues and expenses so you can ascertain the overall profit or loss of the entire venture. And alongside this, that recording venture will also open personal accounts for the other partners just to track the exact amounts owed to or from them. Now, this approach creates a really stark division of labor. The active record keeper takes on the entire administrative burden. I mean, they're tracking every single detail, every receipt, and every sale. Meanwhile, the other co-venturers, they have virtually no burden at all. They don't keep detailed records, they merely send over their capital or inventory to the recording venture and just wait for the final tally. It's highly efficient, sure, but it requires a tremendous amount of trust. Section 3, Method 2, all co-venturers. Under this second method, the pendulum swings entirely the other way. Every single active co-venturer is on the hook for bookkeeping. Every person records absolutely all the joint venture transactions in their respective individual books. To do this, each co-venturer opens their own joint venture account, which serves the exact same purpose as a profit and loss account for the project, as well as personal accounts for everyone else involved. As you can probably guess, if everyone is maintaining a full parallel set of records, constant communication isn't just nice to have, it is literally vital for success. Let's walk through how this flurry of communication actually plays out in practice. Step 1. An active co-venturer undertakes a transaction. Let's say they pay a vendor. Step 2. They absolutely must inform all the other partners regularly and promptly about this exact transaction. Step 3. All parties then incorporate those details into their own respective books. Just think about the coordination required here. If someone forgets to send an email or make a quick phone call about an expense, everyone's books are instantly out of sync. But on the flip side, if it's managed meticulously, it ensures total transparency and gives every single partner a complete, real-time view of the venture's financial health. Which brings us to Section 4, Method 3, the memorandum accounts. And this brilliantly illustrates a really clever hybrid approach. Instead of tracking the entire venture and duplicating everybody's efforts, each co-venturer now records only the transactions they are directly involved in. They open a specific relationship account, named something like Joint Venture with John Doe account. But here is the crucial limitation. Because these only track isolated, individual dealings, they do not disclose the overall profit or loss of the entire venture. You basically only have visibility into your specific piece of the financial puzzle. So, how do we assemble those pieces to see the completed puzzle? Well, we use a great equalizer, the Memorandum Joint Venture Account. This is an additional statement that completely solves our visibility problem. It's prepared exactly like a standard profit and loss account. taking the combined information supplied by all the separate co-venturers to finally figure out the big picture. But importantly, this memorandum account sits entirely outside the formal double-entry accounting system. It is purely an informational worksheet. It's kind of like a scratch pad, used strictly to calculate the final aggregate numbers without messing up anyone's formal permanent ledgers. Let's wrap up with Section 5, the final profit share. So the crucial point is, how does this memorandum account actually find that final profit? It's simple. You just tally up all the combined memorandum expenses from all the partners on the debit side, and you combine all the memorandum revenues on the credit side. The difference between those two totals perfectly dictates the definitive profit or loss for the entire joint venture. Once that master number is definitively calculated on the memorandum statement, all the technical accounting heavy lifting is officially done. The final profit or loss is simply shared among the co-ventures strictly according to their previously agreed upon profit-sharing ratio. It doesn't actually matter who kept the most records or who did the most buying and selling. The final financial payout is driven purely by that single unified calculation in your original contract. We've looked at 3 very different ways to manage your books today. Delegating everything to a single partner, the extreme transparency of everyone tracking absolutely everything, and that clever hybrid memorandum approach. So, I want to leave you with this provocative question. Which recording method would you trust with your next joint venture? Think about the administrative bandwidth of your team, the level of transparency you really need, and honestly, the trust you have in your partners. Understanding these structures empowers you to make the right choice from day one. Thank you for joining me for this explainer, and as always, keep learning.